I could be about to potentially change the way that you think about loans. It's about interest-only secured loans. You might be thinking, is that even a thing? The answer might surprise you. Let's break this down. Interest-only secured loans might sound uncommon, and to be honest, they are. However, a home equity line of credit, or HELOC, offers a similar option with interest-only payments during the draw period. This allows homeowners to access a loan in stages using their home equity as collateral. Another alternative to consider is a reverse mortgage. This interesting product allows for interest-only payments and requires the property to be sold to repay the principal debt when the homeowner passes away or moves into aged care. Now, we know that secured loans often offer larger borrowing amounts and lower interest rates compared to unsecured loans, but they do carry a risk, the risk of repossession if repayments aren't made. That's why it's crucial to only use lenders that are authorised and regulated by the FCA, that's the Financial Conduct Authority. They'll ensure that your rights as a borrower are protected. Now, let's go into a bit more detail on what a secured loan really is. The borrower lists one of their assets, often a property, as a security in the loan agreement. This means a creditor can repossess and sell the asset to recover the debt, but only if the borrower can't keep up with the monthly repayments. What's the real cost of a bad secured loan? Well, imagine borrowing 30 grand at 4% on a 15-year term. That will cost you 221 quid a month. Now, if you were to get the same loan at 5%, it's only £18 more a month. But over the term, that's a whopping £2,916 more. The big difference between secured and unsecured loans is that secured loans require an asset as security, and this makes you more appealing to a borrower with less lending risk, which can often mean lower interest rates. Even those with poor credit history can still get a secured loan, albeit likely with a higher interest rate. Secured loans usually provide a lump sum that's repaid over time. But what if you could get a loan where you only repay the interest and not the principal amount? It sounds too good to be true, doesn't it? Well, unfortunately it is. You can't get a secured loan where you only pay the interest rate and never repay the principal loan amount. But a HELOC comes close. With a HELOC, you only make interest payments for a fixed duration before starting to repay the principal loan amount. A HELOC is a loan against your home equity. During the draw period, you can take parts of the loan in stages and only have to pay a variable rate of interest. Once the draw period's over, you start paying off the principal loan amount and the interest rate until the loan's repaid. You can take out a secured loan against a property that already has an outstanding mortgage. This loan would be secured against the equity that you have in the property. Sounds interesting, right? Well, let's go a bit deeper into this just to understand how it works. So how do you calculate your home equity? Well, it's pretty straightforward, to be honest. You just need to subtract your mortgage debt along with any other debt secured by the property's equity from the market value of your property. Subject to meeting the lender's criteria, you might be eligible to take out a loan up to 80% of the value of your home equity. That could potentially be a significant amount, giving you the financial flexibility that you need. Now, what if you have a buy-to-let property? Good news, it's also possible to secure a loan against the equity that you've built up in such a property. Imagine this. You purchased an investment property several years ago, or maybe even decades ago. Through the years of diligent buy-to-let mortgage repayments, the property might nearly be paid off, providing you with a significant amount of equity. This equity could be your ticket to securing a loan. You might use this loan to purchase other properties, make other investments, or perhaps make improvements to the rental property. These improvements could then allow you to charge more in rent, leading to a higher income stream. So there you have it. While interest-only secured loans might seem like a dream, a HELOC or even a reverse mortgage could offer similar benefits. It's always important to understand the risks and costs associated with securing your debts against your property. Do your research, make informed decisions, and consult with professionals when needed. If you're interested in finding a loan for your circumstances, simply click the link below and fill out the short form. It contains a few questions like whether you're a homeowner and how much you'd like to borrow, and it'll give you access to quotes from around the UK tailored to your circumstance. It's totally free to do it, and of course it's not going to affect your credit score. Click the link below, fill out the short form and give it a try.